Markets were mixed today. The Nasdaq leading the losses as investors sold shares in tech-related names. Let's go to Keith Buchanan on the senior portfolio manager at Globalt Investments. Keith, NVIDIA CEO says no bad blood between his company and OpenAI, but you have concerns about, do you have more concerns about that deal or others like it?
Sure, and thanks again for having me. We've looked at this deal, as well as the entire group, as having this circular nature that was concerning to us when some of these deals were talked about 12, even 18 months ago. The nature of these deals kind of brings along a risk that we feel like the market wasn't really grasping, in that the dominoes are put much closer together as we have a lot of overlapping funding mechanisms and also optimism that one deal that's actually moved south of 20 or 25% really doesn't affect the entire secular opportunity, but it could affect the valuation of these names and these stories in the very near term. That was a concern that we had several months ago, as I mentioned, and it's one that still persists today.
All right. What else did you see dragging the North American markets down today?
Sure, we've been moving into this into 2026 and finishing the first month with a lot of concerns of just how the market at least moves forward over the next quarter or so. From an earnings standpoint, we feel like the bar has moved ever higher. And in fourth quarter that we're reporting now, expectations coming into the quarter were 8% growth. Now we're north of that. Now we're closer to 12% growth. And as that bar moves higher, good just isn't good enough. Fair just doesn't cut it. And the market is now expecting great earnings results. And that actually accelerates, those expectations accelerate over the course of 2026. So we feel like the bar is moving significantly higher. And the market's now focused on more than just revenue growth from an interesting or attractive story. We're also looking now at cash flow generation, margin resilience, some of the quality metrics that we feel like kind of indicates where we are in the cycle. So we feel like this earnings season poses a lot of opportunity, of course, but also challenges come with that, with expectations moving as high as they have over the past couple of quarters.
Meta and Microsoft, as you know, reported one went up, the other went down. Is that return on investment for AI still what investors are very hyper-focused on?
Sure. We feel like the market is differentiating between the picks and shovels of the AI story to those longer-dated payoffs that have more upside in the outer years. And in that spectrum, of course, corporations lie anywhere along that spectrum. But I think the key factor in how the market has shifted over the past month or so is understanding the funding mechanisms that takes you from one point to the next along that spectrum. And that's what the market is really starting to digest. We feel like it's a healthy exercise. The market is dissecting and discerning between stories that have cheaper, more immediate funding mechanisms that aren't related to the story next to it. But as we go through this process of unwinding each one of these stories and making sure the cash flow generation prospects that are baked into some of these names over the coming years really have the sustainability as we move along that spectrum again to realizing some of these gains of the first phase of this AI infrastructure build out to move into those later phases of those longer dated payoffs that we see the market really valuing fairly highly in this part of the cycle.
Okay, as investors are going through that, what matters now? Where is that storyline shifting to and shifting away from?
Right, we see the storyline as kind of aligning with what the broader market is really valuing, and that's quality, cash flow generation, and margin stability. If those stories don't start to demonstrate that in a very material way, especially again, some of the overlapping nature of the deals that have been struck and some of the optimism that's baked into these names as far as a revenue standpoint, the valuations can continue to start to drain into other spaces that can demonstrate that quality and cash flow generation outside of the AI-centric and adjacent spaces to even outside of tech into more old economy names that we've seen perk up a lot over the last month and a half. So that's what we're really seeing develop. We've seen some of that attention move outside of the space of tech in a very, again, not necessarily disorderly or unhealthy way, but it presents new challenges to the tech story that we have to see fulfilled in execution on a quarter-to-quarter basis.
All right, let's talk to a couple of stocks that you actually are looking at these days. One of them is Gap. What do you like about Gap?
Right, the turnaround story, in our opinion, is really significantly underway. We've seen some of the merchandising improve. Cost controls have become really more in focus. Q1 really demonstrated that, and we see that starting to continue into as we get further in 2026. And upside to expectations, we feel like is really underway and not necessarily priced into this stock. We feel like it's priced like a broken retailer story. And some of the execution that they've been able to demonstrate over the last couple of quarters really hasn't started to be priced in to push forward valuations into 2026. So we feel like that's an opportunity to buy the shares here, and we've been really optimistic about the offering kind of going into 2026.
Okay, let's get to your next pick, which is Goldman Sachs, and why are you liking Goldman Sachs compared to the others?
Sure, a completely different story than Gap, of course. But it's a pure play cap markets story right now that they demonstrate in the first quarter robust earnings power as we kind of, and as well as some of the bulge bracket names as far as some of the ancillary businesses they own that Goldman is a front runner as far as setting a standard in some of those cap markets businesses. We really see that developing over the course of 26 to have valuation that coalesces around Goldman Sachs's revenue streams. And we don't feel like that's necessarily under threat if we don't have the acceleration of Fed rate cuts, like what is driving some of the valuations outside of cap markets within the financials industry. So we feel like it's a really attractive, pure play, if you will, and of course, very quality management team and opportunity set that really benefits this name in 2026.
Okay, Keith Buchanan, got to leave it there. Thanks for your time. Appreciate it.